There is no such thing as a perfect investment. Every investment comes with a trade-off. More growth can mean more volatility, more predictability can mean less potential upside, and more flexibility can come with additional complexity. The goal isn't to eliminate the trade-offs, it's to understand which ones are worth taking. Welcome back to Pointe Perspective, where each week we break down the markets, the economy, and the financial decisions that shape your future. If you don't have time to watch every episode, we also publish a weekly newsletter highlighting the biggest takeaways, and you can subscribe using the link below. I'm Christiana Lovelace. I'm a licensed financial advisor and accredited asset management specialist and the founder of Diamond Point Financial. This week, we're discussing the bond market, where higher yields are creating some interesting conversations for both investors and companies. Then we'll continue our discussion around the labor market by looking at immigration, an aging workforce, and why the economy may not need to create as many new jobs as it once did. And finally, we're continuing our portfolio management series. We'll compare different investment tools, and I'll introduce you to an investment structure that's becoming a growing part of the advisory portfolios we manage here at Diamond Point Financial. Good investment management isn't about finding one investment that's better than everything else. It's about understanding what each investment is designed to do, what you're giving up to own it, and whether that trade-off actually makes sense for you. That's the philosophy behind the portfolio management process at Diamond Point Financial. Because you don't need every investment opportunity available. You need the right combination of tools for what you're trying to accomplish. And if you have questions about your own situation, or you'd like to learn more about the 4 cornerstones of financial planning and our established point process, you can visit our website using the link below. The bond market is a lot sexier than people give it credit for. Most people think of bonds as the boring part of investing, just the place you put money when you don't want much excitement. But there's actually quite a bit of drama always happening in the bond market, especially this week. The U.S. Treasury is issuing a new 20-year bond, and long-term government bonds have recently been offering yields around 5%. At the time I'm recording this, we don't know the final yield on the new bond. That will be determined through Wednesday's auction, and I'll include the final numbers on Friday's Pointe Perspective newsletter. But for comparison, the last new 20-year Treasury issued in May carried a 5% coupon, and it auctioned at a 5.122% yield. There is discussion that this particular round could reach as high as 5.25. While it's still significantly below the double-digit peaks we saw in the early 80s, today's 20-year yields represent some of the highest borrowing costs and investor payouts we've seen. And Treasuries carry relatively low credit risk, so an investor willing to commit money for 20 years may be able to lock in a fairly attractive income stream. But that 5% doesn't exist in a vacuum. When government bonds start paying investors more, the rest of the market has to respond. If the U.S. government is willing to pay you around 5%, how much would a corporation have to pay you before you lend money to them instead? That's one of the conversations happening in the bond market. Corporate bonds carry additional credit risk, so investors generally demand additional yield to compensate for it. That difference is called a credit spread. It's the additional yield a corporate bond offers over a comparable Treasury. And when Treasury yields remain elevated, borrowing can become more expensive for corporations as well, depending on where those credit spreads are trading. This brings us right back to our recent conversations about artificial intelligence and capital expenditures. Companies are spending extraordinary amounts of money on AI infrastructure, and some are borrowing to help finance it. As we've discussed in previous weeks, the more expensive the debt becomes, the greater the return those investments eventually need to generate to justify their financing costs. But this isn't just a bond story. If relatively low credit risk treasuries are offering around 5%, stocks, real estate, and other riskier investments are competing against that return for investor capital. Higher treasury yields effectively raise the hurdle investors may require before taking on additional risk. That's why what's happening in the bond market can eventually influence valuations across the broader market. And here's where bonds become considerably less boring. A Treasury paying around 5% can still gain or lose market value. Bond prices and interest rates generally move in opposite directions. So if an investor buys a long-term Treasury around today's rates and comparable yields later fall, their existing bond becomes more attractive and its market value can rise. If rates were to rise instead, the opposite can happen. That's called interest rate risk, and it generally becomes more significant with longer-term bonds. So two investors could purchase the same Treasury with completely different intentions. One may want to hold it to maturity and collect the income, while another may believe rates will eventually decline and see the potential for price appreciation. Same investment, different strategies, and different risks. That's why I think bonds deserve a little more respect. They can provide income and diversification, but they're also actively priced investments responding to interest rates, inflation, credit conditions, and investor expectations every day. So the bond market isn't nearly as boring as some people would think. Most people just don't know what to watch. What if the US doesn't need to create 100,000 new jobs every month anymore? For years, economists have talked about a break-even employment rate. It's essentially the number of new jobs the economy needs to create to keep up with growth in the labor force. Historically, we've often thought about that number as somewhere around 100,000 jobs or more per month. But that estimate may have changed considerably. Recent Federal Reserve research suggests the break-even pace of employment growth could now be much closer to zero. And one of the biggest reasons is immigration. Net immigration added approximately 2.3 million people to the U.S. population in 2024, significantly expanding the potential workforce. More people entering the labor force meant the economy needed to create more jobs just to absorb those additional workers. But immigration slowed dramatically in 2025 and has remained relatively low in 2026. So if fewer people are entering the workforce, fewer new jobs may be required to keep unemployment stable. When we saw payrolls declined by 23,000 last month, while unemployment fell to 4.1%, we discussed the number of people who left the labor force. And that's another piece of context worth considering when we evaluate what those numbers actually mean. And immigration is only half of this story. The American workforce is also getting older. As baby boomers continue retiring, more people are leaving the workforce at the same time that fewer new workers are entering. That can create an unusual economic situation. The economy could create fewer jobs without necessarily creating significantly higher unemployment, simply because there were fewer available workers to fill them. Historically, a slower growing workforce could create challenges because economic growth generally comes from some combination of more workers and greater productivity. If the number of available workers grows more slowly, productivity becomes increasingly important if we want the economy to continue expanding at a similar pace. And this is where economics gets more interesting during periods of technological change, especially when we start evaluating artificial intelligence and its effect on businesses. Businesses may increasingly need to produce more with fewer people through technology, automation, artificial intelligence, and other productivity improvements. And as I watch this transition, one of the questions I'm evaluating is, did businesses proactively adapt to need fewer workers, or were they forced to adapt because workers became harder and more expensive to find? The answer is probably some combination of both, and it will vary considerably by industry. But that's why I wouldn't look at slower job creation by itself and immediately conclude that the economy is weakening. If the size and productivity of the workforce are changing, the numbers we use to define a healthy labor market may need to change with them. Most investment portfolios are ultimately built from two basic ideas: owning something or lending money to someone. That's essentially the distinction between stocks and bonds. When you buy a stock, you're purchasing ownership in a company. If that company grows and becomes more valuable, shareholders have the potential to participate in that growth. But ownership can also come with risk. Stock prices can fluctuate significantly, and companies can underperform, dividends can be reduced or eliminated, and in an extreme case, a company can can fail entirely. The trade-off is that investors generally accept greater uncertainty in exchange for greater long-term growth potential. Now, bonds work a little differently. When you buy a bond, you're lending money to a government, municipality, or corporation. In exchange, the issuer generally agrees to pay interest and return the bond's face value at maturity. That can create a more predictable income stream, but as we've discussed earlier with treasuries, bonds aren't always risk-free either. They carry interest rate risk because the value can decline when market rates rise. They can carry credit risk, which means the issuer could have difficulty making its payments, and they carry inflation risk, meaning the income you're receiving may purchase less in the future if inflation remains elevated. So the trade-off with bonds is generally greater predictability of income and potentially lower volatility in exchange for giving up some of the growth potential associated with stocks. This is where the risk profile we discussed last week comes into play. That risk profile helps us dial in more precisely on the needs of each client. But it's also important to understand that risk isn't simply determined by how many stocks versus bonds that you own. A portfolio of highly speculative stocks carries a very different risk profile than a diversified portfolio of established companies. And a long-term, lower quality corporate bond carries very different risks than a short-term U.S. Treasury. We don't subscribe to the idea that stocks are risky and bonds are safe. We look at what kind of risk we're taking, how much of it we're taking on, and what we're potentially being compensated for taking it. It's a constantly adjusting balance of risk, potential reward, goals, and opportunities. We also don't have to buy those stocks and bonds individually. We can own collections of them through mutual funds and ETFs, or use strategies such as separately managed accounts. The underlying investments may still be stocks and bonds, but what changes is how we own and manage them. A mutual fund and an ETF could own nearly identical investments, so why would we choose one over the other? Both allow investors to pool their money into a collection of investments, which can make diversification considerably easier than purchasing every individual security yourself. And both can be actively or passively managed depending on the strategy. The biggest differences are often found in how they're structured, traded, priced, and taxed. A mutual fund is priced once at the end of each trading day based on its NAV, or net asset value. ETF stands for Exchange Traded Fund. It trades on an exchange throughout the day, much like an individual stock. There's a common misconception among DIY investors that ETFs are always better because they're cheaper and tax efficient. But like most things in investing, it's never that cut and dry. ETFs can offer structural tax efficiencies in taxable accounts because of the way shares are created and redeemed, but the actual tax consequences depend on the specific fund, the investor, and the type of account. Costs can also vary considerably. There are very inexpensive ETFs and mutual funds, and considerably more expensive versions of both. So rather than asking, are ETFs better than mutual funds, a better question is, which structure is more appropriate for what we're trying to accomplish in this particular portfolio? Because ultimately, the label doesn't matter as much as what's actually inside. What if instead of owning shares of a fund, you could actually own the individual investments inside the strategy? That's where a separately managed account, or an SMA, can come into the conversation. With a mutual fund or ETF, you own shares of the fund while the fund actually owns the underlying investments. But with an SMA, the individual securities are generally owned directly in your account while the strategy itself is professionally managed. That can give us another level of flexibility when we're designing the portfolio. And I also like the transparency. Rather than simply seeing shares of a fund on a statement, clients can see the individual securities they directly own. Of course, that doesn't mean SMAs are automatically better than mutual funds or ETFs. They can have minimum investment requirements, costs, and different levels of flexibility depending on the manager and the strategy. But it is another tool we have available when we're constructing a portfolio, and they're becoming a growing part of the advisory portfolios we manage at Diamond Point Financial. What I particularly like about having access to different structures is that we don't have to start with an investment product and try to make the client fit inside of it. We start with the client. What are your goals? What's your time horizon and risk tolerance? What are the tax considerations? Only then can we evaluate which combination of stocks, bonds, mutual funds, ETFs, SMAs, or other investments may be appropriate for the strategy. Having more tools gives us more ways to adjust those different variables as a client's needs change. And as we've said throughout this series, the portfolio shouldn't become the financial plan. The portfolio should serve the financial plan. And having more flexibility in how we construct and manage those investments gives us more ways to intentionally align the investment strategy with the client we're building it for. Interest rates affect investments. Changes in the workforce affect the economy, and every investment we choose comes with its own risks and opportunities. The goal isn't to predict every outcome, it's to understand the variables well enough to make more informed decisions. And when those decisions become more complicated, you don't have to figure them out alone. That's really the purpose behind Diamond Point Financial. We bring investments, tax strategies, estate planning, and insurance all together so that each decision can be evaluated as part of a bigger picture. You don't need to know everything. You just need to know what matters most to you and then surround yourself with the right team. I hope this offered some useful perspective, and until next week, take care.